Warren Buffett has amassed a personal fortune of more than $108 billion by investing in the stock market through his investment firm Berkshire Hathaway. But how has he managed to be so successful? Warren Buffett credits many of his great money decisions to his insatiable reading habit. He says that he starts every morning by poring over several newspapers, financial statements and company reports, and estimates that he spends as much as 80% of his day reading. In fact, when once asked about the key to success, Warren Buffett pointed to his stack of reading material and said, "Read 500 pages like this every day. That's how knowledge works. It builds up, like compound interest. All of you can do it, but I'm guaranteed not many of you will do it." But what is it exactly that Warren Buffett looks for when reading a company's annual reports? And how can it help us to become better investors? To answer this, let's look at how he answers these questions in person at the annual Berkshire Hathaway annual meetings.
I'd like your advice on how to understand annual reports, what you look for, what's important, what's not important, and what you've learned over the years from reading thousands of reports.
Well, we start by looking at the reports of companies that we think we can understand. So we hope to be reading reports, and I do read hundreds of them every year. We hope to be reading reports of businesses that are understandable to us. And then we see from that report whether the management is telling us about the things that we would want to know about if we owned 100% of the company. And when we find a management that does tell us about those things and that is candid in the same way that a manager of a subsidiary would be candid with us and talks in language that we can understand, it definitely improves our feeling about investing in such a business, and the reverse turns us off to some extent. So if we read a bunch of public relations gobbledygook, and we see lots of pictures and no facts, it has some effect on our attitude toward a business. We want to understand the business better when we get through with the annual report than when we picked it up. And that is not difficult for a management to do if they want to do it. If they don't want to do it, we think that is a factor in whether we want to be their partners over a 10-year period or so.
I do think if you've got a standardized bunch of popular jargon that looks like it came out of the same consulting firm, I do think it's a big turnoff. That's not to say that some of the consulting mantras aren't right, but I think there's a lot for sort of candid, simple, coherent prose. A lot to be said for it.
Almost every business has problems, and we just assume the manager would tell us about them. We would like that in the businesses we run. In fact, one of the things, we give very little advice to our managers, but one thing we always do say is to tell us the bad news immediately, and I don't see why that isn't good advice for the manager of a public company. Over time, I'm positive it's the best policy, but a lot of companies, for example, have investor relations people, and they're dying just to pump out what they think is good news all the time, and they have this attitude that that you've got a bunch of animals out there to be fed, and that they're going to feed them what they want to eat all the time, and over time the animals learn. So we try to stay away from businesses like that.
What you seldom see in an annual report is a sentence like this: "This is a very serious problem, and we haven't quite figured out yet how to handle it." But believe me, that is an accurate statement much of the time.
Some really interesting points to consider. Firstly, Warren Buffett only looks at companies that he thinks he can understand. Despite being hugely successful, Buffett doesn't pretend to know everything about every business in every industry. Instead, he's comfortable with what he knows and doesn't stray from that. He often calls this his circle of competence, and wrote a letter to Berkshire Hathaway investors in 1996 that lays out what it means to operate within your circle of competence. He is Buffett in his own words. What an investor needs is the ability to correctly evaluate selected businesses. Note that word selected. You don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Also in the video, Buffett talks about looking at what the business's management is telling them, and also, just as importantly, what they're not telling them. Honesty, integrity and transparency is key to Buffett. I also liked what Charlie Munger added when he said that he rarely sees management say something like, "This is a very serious problem and we haven't figured out how to handle it." All businesses will face risks and threats, and not all of these risks and threats will have an obvious solution in place. I think that annual reports that address and discuss any potential headwinds would be the ones that Buffett and Munger like, as those reports would show that the management is being open and honest, rather than trying to tell investors what they want to hear and not disclosing the full picture. Warren Buffett was also asked a similar question at another Berkshire Hathaway annual meeting about what he looks for in an annual report.
I know that you read lots and lots of annual reports, and I'm curious what you are reading for, if you would share that with us.
If we own stock in a company, in an industry, and there are 8 other companies that are in the same industry, I want to own or be on the mailing list for the reports for the other 8, because I can't understand how my company is doing unless I understand what the other 8 are doing. I can't be an intelligent owner of a business unless I know what all the other businesses in that industry are doing. And so I try to get that information out of a report. If I'm thinking about investing in a specific company, I try to size up their business and the people that are running it. And over the years, I found reading a lot of reports to be quite useful in terms of making business decisions at Berkshire.
Again, some really useful insight into what Buffett looks for, and how he looks to develop a picture of the company and whether or not he's looking to invest. He mentions that he doesn't just read the annual report of the company that he's interested in, and will read the annual reports of all their competitors as well. This competitor analysis will help Buffett build up a picture of the industry as a whole, and how the key players are performing. For example, if you're interested in investing in the Bank of America, you might also read the annual reports of Wells Fargo, Citibank and JP Morgan. Then it might be useful to read the annual reports of some European banks, to build a better picture of the banking industry as a whole. Again, the common theme here is to keep reading and building your knowledge. So, we've looked at what Warren Buffett looks at in terms of evaluating the industry, management and competitors, but we haven't looked at what he focuses on in terms of the financials. This next video asks a great question on that very topic.
Hello, my name is Stuart K, and I'm from New York City. I wanted to know if you could not talk with management, could not read an annual report, and did not know the stock price of a company, but were only allowed to look at the financial statements of a company, what metric would you look at to help you determine whether you should buy a company?
Well, what we're doing in investment, and what everybody is doing in investment, is they're laying out money now to get more money back later on. Now, let's leave the market aspect of the asset out. I mean, when you buy a farm, you really aren't thinking about what the market on it's going to be tomorrow or next week or next month. You're thinking about how many bushels of beans per acre can you get, or a corn per acre, and what the price is likely to be. You're looking to the asset itself. And in the case you lay out, the first question you'd have to make is, do I understand enough about this business so that the financial statements will tell me the information that's useful to me in making a judgment about what those future financial statements are going to look like? If you hand me a bunch of financial statements, you don't tell me what the business is, there's no way I can make a judgment as to what's going to happen. It could have been a hula hoop business. It could have been a pet rock business. On the other hand, it could have been Microsoft early on. So unless I know the nature of the business, the financial statements aren't going to tell me much. But we've bought lots and lots of securities. Charlie, the majority of the securities Charlie and I have bought, we have never met the management and never talked to them. But we have primarily worked off financial statements, our general understanding of business, and some specific understanding of the industry and the business we're buying. Charlie?
Yeah, I think there's one metric that catches a lot of people. We tend to prefer the business which drowns in cash. It just makes so much money that one of the main principles of owning it is you have all this cash coming in.
Yeah, it's a lot easier to understand a business that's mailing you a check every month.
So Buffett won't just look at a company's financial statements in isolation when making an investment decision. It's always a three-pronged view, looking at the financials, the business, and the industry as a whole. I think this is a really important point. Most people can look at historic financial statements and see if the revenue or the net income is increasing or decreasing. But this doesn't really mean much if the industry is under serious threat over the next coming decade, or if competitors are introducing new products and services that are proving to be popular. I like what Buffett said about buying a farm. If you buy a farm today, you aren't immediately thinking about what you can sell it for in the short term. As he puts it, you're thinking about how many bushels of beans per acre you can get, or corn per acre, and what the price is likely to be. I.e., you're thinking of how the business is going to operate day by day in order to make money. And this can be applied to how we invest. Don't just look at the numbers behind the stock, look at the business and how it's going to run over the long term. Charlie Munger also shared some of his wisdom, and said that himself and Buffett tend to prefer the business which drowns in cash. So when they look over financial statements, they both focus on the cash flow statement, and look for businesses with a high cash flow. As a qualified accountant, I can see the appeal in this, as a company's revenue and earnings can be manipulated through accounting adjustments, such as accruals and prepayments. It's all perfectly legal and common practice, and all adjustments will be scrutinised by independent auditors before being released in annual reports. But a company's earnings and revenue numbers don't necessarily reflect the cash flows in their bank accounts. For example, a business could strike a deal in the last month of the financial year, and this would be recorded in the financial statements. Then, in the next financial year, that deal might fall through. So no cash was ever received on the deal, even though it was reported in the financial statements. There is an accounting saying that you can't pay your staff with earnings, and what this means is that a company could report high earnings, loaded with numerous accounting adjustments, but if they haven't actually received the physical cash associated with the transactions, then there isn't actually any money in the bank to pay the staff. At the end of the day, cash is cash, and companies can't just overinflate their cash flow and exaggerate what's sat in their bank account. You've either got it or you haven't. And companies that generate high levels of cash will generally do well, as they have multiple options to choose what to do with that cash. They can easily pay their staff, replenish stock, and pay utility bills, etc., and still have enough left over to look to grow the business through external acquisitions or internal reinvestment. And as a dividend investor, a high cash flowing business also has a lot of scope to increase their dividends. So do Warren Buffett and Charlie Munger pay any attention to the common investor ratios and metrics, such as PE ratios and return on equity, that can be found in financial statements? Let's look at how they answer that particular question at another annual meeting.
Hi, Warren and Charlie. My name is Vincent W from Seattle. When people analyze a stock, a lot of them look at quantitative metrics such as PE ratio, return on equity, debt to asset ratio, etc. So, Mr. Buffett, when you analyze a stock for purchase, what's your top 5 quantitative metrics that you look at? And what's your preferred number for each metric? Thank you.
Well, we're looking at quantitative and qualitative. We aren't looking at the aspects of a stock. We're looking at the aspects of a business. It's very important to have that mindset that we are buying businesses, whether we're buying 100 shares of something or whether we're buying the entire company. We always think of them as businesses. So when Charlie and I leaf through Value Line or look at annual reports that come across our desk or read the paper or whatever it may be, that for one thing we do have this cumulative knowledge of a good many industries and a good many companies, not all by a long shot. And different numbers are of different importance, or various numbers are of different importance depending on the kind of business. And over the years, we've accumulated this background of knowledge on various kinds of businesses. And we also have come up with the conclusion that we can't make an intelligent analysis about all kinds of businesses. So we have certain things we think about in terms of a bank that are different than we think about when we're buying his car. And so there is not one size fits all. We think about when we're buying an insurance company. There's certain things we think about when we're buying a company dependent upon brands. Some brands travel very well, Coca-Cola being a terrific example, and some brands don't travel. And we just keep learning about things like that, and then every now and then we find some opportunity. And it's not because I calculate some precise PE ratio or price book value ratio or whatever it might be. It is because I have some idea of what the company might look like in 5 or 10 years, and I have a reasonable amount of confidence in that judgment, and there's a disparity in price and value, and it's big. Charlie, would you like to elaborate?
We don't know how to buy stocks just by looking at financial figures and making judgments based on ratios. We may be influenced a little by some of that data, but we need to know more about how the company actually functions.
It's not like we sit there and say, we want to look at things that are low to price to book value or low PEs or something of the sort. We are looking at businesses exactly like we'd look at them if somebody came in and offered us the entire business. And then we try to think, what is this place going to look like in 5 or 10 years, and how sure are we of it?
People with very high IQs who are good at math naturally look for a system where they can just look at the math and know what security to buy. It's not that easy. You really have to understand the company and its competitive position and the reasons why its competitive position is what it is. And that is often not disclosed by the math.
Again, Buffett stresses that whether they're buying 100 shares of the company or buying the whole company, the focus is always on the business, not the stock. It's an important distinction to make. When you're buying stocks, you are buying a share of that company, however small it may be. You're not buying fluctuating numbers on a screen. You're buying part of a business. So the focus has to be on that business. Charlie Munger even admits that they don't know how to buy stocks just by looking at financial figures and making judgments based on the ratios. He says that people do naturally look for a system where they can just look at the numbers and know what security to buy, but then advises that it's not that easy. So while I think that the financials can tell part of the story, the rest of the narrative needs to come from thinking about the actual business itself and how that operates within the overall industry. What do you think about Warren Buffett's views on annual reports? Is this something that you can take into your own investing journey? Let me know in the comments section below. I'll be reading and responding to every message that I can. I hope that you found this video interesting and informative, and I hope that it's given you inspiration and ideas for your own personal finances and investing journey. If you have, then please like the video and subscribe to the channel to make sure that you don't miss any future videos. Thanks again for watching, and I'll see you in the next video.